Group health insurance is insurance a business or association, the plan sponsor, offers to its employees or members, the plan participants. The sponsor is the policy owner and primary premium payer. The members are the insureds and may contribute to the premium. For simplicity, the term employer in this lesson refers to the group sponsor. The group insurance contract. The insurer issues a group insurance contract to the sponsor. A single group policy can cover many people and their dependents. As the group policy's applicant and owner, the sponsor selects the plan benefits and receives a master policy. Certificates of insurance and outlines of coverage and benefits are issued to the members. Individuals can enter and leave the insured group without affecting the policy. This is because the members are not named as individual insureds in a group policy. Group versus individual contract. People insured under a group health plan pay less than those who have identical coverage under an individual policy. This is because it costs the insurer less to insure a group since the risk is spread over many people. The cost of underwriting a group health plan is lower than underwriting an individual health policy. In addition, the insurer spends less to sell and administer the group plan. Group insurance also costs less than individual coverage because the employer pays some of the premium. Other advantages and disadvantages of group coverage include: qualifying for group coverage is easier than qualifying for individual coverage. Group insurance applicants do not undergo the same level of underwriting as individual applicants. Group coverage is more likely to end than individual insurance. Coverage can end if the individual leaves the group. In contrast, individual coverage does not depend on group membership. No individual benefit selection. Group plans provide a predetermined schedule of benefits. Group members cannot choose their benefits. The benefit schedule specifies who is covered by what, and when and how they are covered. This schedule can reflect participant earnings, position, or length of service. However, the schedule cannot benefit only one or a select few people in the group. Self-insured versus insured plans. Group health coverage can be either self-insured, self-funded, or fully insured. Under self-insured plans, the employer pays member claims and benefits. The employer can offer benefits that are best suited to employees' needs. This gives the employer more control over costs and flexibility over benefits. Self-insured plans are common to multiple employer trusts, METs, or multiple employer welfare arrangements, MUAs. They are also common among small insured groups that have relatively healthy members and few claims. Self-insured plans often have an insurance company administer them. The insurance company is not responsible for claims payments. It renders this service under an Administrative Services Only (ASO) contract. In a partially self-insured plan, an employer may share the risk of covering claims by buying stop-loss insurance coverage from an insurance company. The employer is still liable for paying claims under the plan, but only up to a certain amount before the insurer pays the rest. Stop-loss policies are most helpful to employers that could have catastrophic or numerous claims. With an insured plan, an insurer takes the risk of covering member claims and benefits. The employer pays premiums to the insurance company just like any other insured. Contributory plans versus non-contributory plans. Group health insurance plans may require participants to pay some of the premium. Such plans are called contributory plans. To control costs, many employers require their employees to contribute to the premium through payroll deductions. Plans that do not require participants to contribute to premium payments are called non-contributory plans. Eligible groups. Only certain types of groups qualify for group insurance. State laws prohibit insurers from selling a policy to a group formed for the sole purpose of buying group insurance. Key point. To qualify for group insurance, a group must have been formed for some reason other than getting insurance for its members. It must be a natural group. A natural group is a collection of individuals who work in the same place or belong to the same organization. Natural groups eligible for group insurance are. Please pause the audio and review the table. Minimum size. To be eligible for group health insurance, a group must qualify based on its size. 3 entities mandate the minimum size of groups. The Internal Revenue Service, IRS. The state in which the group resides. The insurer underwriting the plan. Key point. Most states and many insurers require that a group have at least 10 members to qualify for standard group coverage. Many states require certain groups, such as creditor groups, to have more. A mandatory minimum group size helps to spread the risk and the administrative costs over enough participants. Small group market. While most states require at least 10 employees for an employer to qualify for standard group insurance, employers with fewer than 10 employees can qualify through the small employer market. Under the Health Insurance Portability and Accountable Act, HIPAA, each state must permit groups with fewer than 10 people to buy group health insurance. Some states define a small group as 2 to 50 employees. Others define it as 1 to 50 employees. Policies designed for the small group market have special conditions. For instance, they must be guaranteed renewable. Common group health insurance products. A group insurance equivalent exists for every major type of individual health insurance product. Many employers offer their employees several types of insurance products, though not always from the same insurer. Employees can select coverages that best suit their needs. Some selections require the employees to pay or contribute to the premium. Other selections do not because the employer pays the entire premium. Common group health insurance plans include medical expense plans, long-term and short-term disability plans, accidental death and dismemberment plans, long-term care plans, dental insurance plans, vision insurance plans. In general, group health policies provide the same type of benefits available with individual policies. Benefits may be fixed, or scheduled, and the same for everyone or related to the insured's earnings. For instance, group medical insurance benefits are scheduled benefits, while group disability benefits are a percentage of the insured's earnings. Indemnity or managed care approach. Group medical insurance coverage is available through traditional indemnity policies as well as managed care plans. Major medical insurance was long the staple of group medical plans, but today many plan sponsors use managed care. Worksite, employer-sponsored, wellness plans. Many employers encourage healthy lifestyles for their employees by sponsoring programs that give employees opportunities to improve their health. This benefits the employer when the group health plan sees fewer claims arising from employees' health problems. Some group insurers encourage plan sponsors to offer a wellness program by discounting the premium for those that do. Worksite plans can benefit employees' health and improve their productivity and job satisfaction. Wellness programs can include health education classes, weight management programs, on-site exercise facilities and discounts on gym memberships, and routine vaccinations and screenings. Eligibility and participation requirements. Employees must meet certain criteria, set by the employer, within insurer and state guidelines, before they can join a group health plan. An employer may require, for instance, a minimum period of full-time employment, such as 1 to 3 months, before employees may participate. Part-time employees are usually not eligible for group health insurance coverage. However, an employer may choose to let them participate in the plan. Although the employer sets the eligibility standards, the insurer sets the minimum participation standards. The insurer requires that a certain percentage of eligible members of a group participate in the plan. This protects the insurer from adverse selection. There are typically 2 participation standards. Non-contributory plans, in which the plan sponsor pays the entire premium, must cover 100% of those eligible to participate. Contributory plans, in which the plan sponsor and the members contribute to the premium, require at least 75% of eligible members to participate. Plan enrollment. Enrollment in a group plan is not automatic. Eligible employees choose to participate in a plan by enrolling in it. If they enroll in a contributory plan, they pay their share of the premium through a payroll deduction. During the enrollment process, employees identify any family members, such as a spouse and dependent children, to be covered by the plan. They must also identify other health insurance coverage they may have. Employees may enroll in a group plan. when first becoming eligible to participate. Annually during the plan's open enrollment period. If there is a loss or termination of current group coverage. Over 65 coverage. The law requires employers to offer employees age 65 and older the same medical coverage offered to younger employees. Coverage offered to spouses must be the same regardless of age. Employees receiving Medicare benefits can reject the employer's planned coverage, making Medicare their primary insurer. The employer cannot offer these employees or spouses a Medicare supplement plan that pays for services covered by Medicare, because doing so would duplicate benefits. If a person is covered under both a group plan and Medicare, the group plan is the primary coverage, unless the group has fewer than 20 members. Medicare is the secondary payer that may cover medical expenses exceeding the group plan's benefits. If a group plan refuses payment for medical services, Medicare will pay only for services that Medicare would normally cover. Medicare carve-out plan. Rather than provide full medical coverage for their Medicare-eligible employees, some employers offer a Medicare carve-out plan. Sold by private insurers and managed care providers, these plans complement Medicare coverage and cost the same as coverage for younger employees. Although a carve-out plan may be offered as a retiree health plan, it is primarily intended for active employees who are eligible for Medicare. A carve-out plan makes Medicare the primary payer. Rather than provide full coverage, a carve-out plan covers only the difference between what Medicare pays and what the employer's group medical plan would pay without Medicare. The insurer or managed care provider calculates the benefits an employer's group medical plan would pay if it were the employer's only insurance, subtracts, carves out, Medicare's payment, and then pays the difference. Though it may seem like carve-out plans resemble Medicare supplement insurance, there is a significant difference. A Medicare supplement policy pays benefits in addition to what Medicare pays so that 100% of many expenses are covered. A carve-out plan pays benefits that fill the gap between what Medicare pays and what the employer's group medical plan would pay without Medicare, leaving the participant responsible for deductibles and coinsurance. Waiting period. Group health plans have a waiting period, or exclusion period or probationary period, which is the time that must pass before a person is eligible for coverage and benefits. Employers and insurers determine the length of the waiting period, typically 30, 60, or 90 days. All new plan participants have the same waiting period, regardless of health. Pre-existing conditions. Before the Patient Protection Affordable Care Act, ACA, group health plans routinely excluded coverage for pre-existing conditions. Though plans issued after January 1, 2014, cannot exclude pre-existing conditions from coverage, producers should be familiar with how they work in plans with grandfathered status, those that were in effect by March 23, 2010, the day the ACA became law. These plans do not need to provide the benefits, rights, and protections of the ACA. A pre-existing condition is a health condition that the insured was diagnosed with or treated for, or for which treatment was recommended within the 6 months before the insured enrolled in the plan. Before the ACA, there were 3 rules that insurers had to follow when excluding pre-existing conditions from coverage. Pre-existing conditions could not be excluded from coverage longer than 12 months, 18 months for late enrollees and 18 months with self-insured plans. Under a group insurance plan, pregnancy could not be treated as a pre-existing condition. The exclusion period for pre-existing conditions had to be reduced for any time that prior creditable coverage satisfied the exclusion period. Creditable coverage means coverage under a prior medical insurance plan, with no break in coverage lasting more than 63 days. Example: pre-existing condition exclusion periods ran concurrently with a plan's waiting period. A plan with a 2-month waiting period and a 6-month pre-existing condition exclusion period would exclude coverage for only 4 months after the employee enrolled in the plan at the end of the waiting period. Pre-existing conditions under the Affordable Care Act. Coverage of pre-existing conditions changed with the ACA. Now children under age 19 who are covered under their parents' medical plan cannot be denied coverage for a pre-existing condition. As of January 1, 2014, no health insurance plan may exclude coverage of pre-existing conditions for any adult applicant or dependent. Furthermore, no health insurance plan may charge more for an applicant with a pre-existing condition than one without a pre-existing condition. Conversion privilege. Group medical expense insurance plans have a conversion privilege that lets a participant convert group coverage to an individual plan with the same insurer. Insurers can evaluate the risk the person presents and charge the appropriate premium. However, the insurer cannot deny coverage even if the person would otherwise be uninsurable. Coordination of benefits. Unique to group health insurance plans is the coordination of benefits, COB, provision. Included in every group health insurance policy, COB avoids overinsurance by preventing duplication of benefits when a participant is covered by more than one group plan. Duplicate coverage often occurs when spouses are both covered under their own group plans. The primary plan first pays its full benefit amount on a claim. Only after that can the insured make a claim on the secondary plan. The claim is limited to the cost that the primary plan did not pay. If a group plan participant is also covered by a spouse's group plan, the participant's plan is the primary plan and the spouse's plan is the secondary plan. If both spouses have plans covering their children, the plan covering the spouse whose birthday occurs first in a calendar year is the primary policy. Subrogation. Insurers have the right to recover benefits paid to a group plan participant if the participant receives payment for medical expenses from a third party. This can occur when a third party causes the illness or injury to the participant and the participant sues the third party to recover the costs of medical care. The insurer can seek reimbursement from the third party and from the participant for any benefits the insurer paid. For your review. It costs less to insure a person under a group health insurance plan than it does to insure a person under an individual health insurance policy because the administrative costs and risk are spread over many people. All participants in a group plan choose from the same benefits. It is easier to qualify for group coverage than individual coverage because eligibility depends on membership in the group, not on personal risk. There is little or no individual underwriting. To qualify for group coverage, the group must be natural. It cannot have been formed to get insurance for its members. In a self-insured plan, the employer pays covered claims. In a fully insured plan, an insurance company pays covered claims. Group medical insurance plans are available as traditional indemnity policies as well as managed care plans. Non-contributory plans must cover 100% of group members eligible to participate. Contributory plans require participation from at least 75% of group members eligible to participate. If a person is covered under both group insurance and Medicare, the group plan is the primary coverage unless the group has fewer than 20 members. A health insurance plan issued since January 1, 2014, cannot exclude coverage of pre-existing conditions for an adult applicant or dependent. A health insurance plan cannot charge more for an applicant with a pre-existing condition than one without a pre-existing condition. Please pause the audio and watch the video.
Medical insurance, one of the various types of group health insurance, is the primary source of medical care for many Americans. One of the greatest benefits of group life insurance is that even people who would be otherwise uninsurable are covered under a group health plan, presuming that they meet the basic qualification requirements of the employer to be covered in the plan. In other words, group underwriting does not look at the individual risk presented by the insured employees, but rather looks at the makeup of the company in determining premium rates. Now, it might sound like group medical insurance is the answer for those who are uninsurable, and while this is true to a certain degree, we want to make sure we understand that insurance companies aren't totally defenseless in guarding against what we call adverse selection, or the tendency of those who are uninsurable or needing insurance to try to obtain insurance. Specifically, there are several conditions that help to protect insurance companies against adverse selection, and they are, first of all, to qualify for any type of group medical insurance, the group itself must be a natural group, an employer, a labor union, an association. You cannot just have what we call a pickup group of individuals who are otherwise uninsurable get together and say, hey, let's form a group and buy some group insurance, and that way we'll get coverage. Doesn't work that way. By making sure it's a natural group, the insurance company has a greater assurance that there will be plenty of healthy risks in the group to offset the inevitable uninsured individual that's brought in. Second of all, Group health plans have minimum size requirements. In most cases, group plans must include at least 10 employees. Same as the must be a natural group condition, the minimum size requirement makes sure that there are some healthy risks interspersed into the group to help, again, offset the inevitable uninsurable individual. Third of all, group medical insurance plans cannot allow individual benefit selection. The plan itself defines the benefits, and that's the way it is. This prevents individuals coming in and picking and choosing the types of coverages that they want to compensate for the fact that they may be uninsurable. And then last of all, group medical plans have minimum participation requirements. If the plan is non-contributory, meaning the employer pays the entire cost, 100% of the eligible employees must be covered in the plan. If the plan is contributory, meaning employees are asked or must contribute a part of the premium, then at least 75% of the eligible employees must elect to participate. Now let's talk about this really quickly. Why is that? If a plan is non-contributory, the employer pays it all, it's not inconceivable that you could have an employer who is uninsurable, who needs medical insurance, say to himself, well, you know something? I'm going to create a group medical plan, and that way I'll get insurance, but I don't want to pay for anybody, so I'm going to spread the word on the floor. If you sign up for this coverage, you're fired. Can't do it. If it's a non-contributory plan, everybody who meets the basic eligibility requirements must be covered. On the other hand, if it's a contributory plan, the employer's got to make the plan attractive enough that enough people will say, hey, I want to participate in that plan. Because if you can't get 75% of the people to participate, it won't qualify for coverage. So if you understand these four basic requirements, then you'll understand how it is insurance companies guard against adverse selection and the inevitable uninsured individual that is covered under the group plan.
Okay, did you catch all that? Well, if you did, here are the 4 questions for this lesson. Ellen participates in a group health insurance plan. Why does her premium differ from that premium she would pay for comparable coverage under an individual plan? Group coverage costs more than individual. Underwriting group health costs more than underwriting individual health. I would say the last one, but I'm not positive. Okay, contributory plans typically require what minimum percentage of eligible employees to participate? I know he said this, and I think it's 80%. All right, a company's group health plan specifies that if an insured is eligible for benefits under another policy, the plan will be the primary plan. Which provision does this? Coordination of benefits. Which provision does this? Conversion privilege. I'm not sure about that one. Who determines the coverage and benefits offered under employer's group plan? The insured employee and employer. All right, let's see how I did. And I got none of them right. Look at that, which is probably typical. All right, so number 1, Ellen participates in a group health insurance plan. Why does the premium differ from that of a comparable coverage under an individual plan? Because the risk for a group is spread over many people. That's the answer. Coverage costs less for group plans, by the way. The answer for this I can't even speak this word. Contributory plan is 75%. Eligible employees to participate. All right, number 3, a company's group health plan specifies that if an insured is eligible for benefits under another policy, the coordination of benefits is the provision that does this. It avoids duplicating benefits when a group participant is covered by more than one plan. It identifies the primary plan and provides full benefit amount. Only after the primary plan has paid its full benefit can the participant make a claim. All right, so the last one is who determines the coverage and benefits offered under an employee's group plan, which would be the employer, not the employee. All right, that's the end of this long lesson. I'll see you on the next one.